Hey everyone, welcome back to Corporate Decoder. Today, GRAF Global Corp just filed an 8K, and there is a quiet move happening that could be a big deal involving shareholder stakes. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing reveals a critical agreement to extend the company's deadline to find a business partner, and it hinges on how many shareholders decide to cash out. Alright, let's dive into what GRAF Global Corp has reported. This is called an 8K filing, which essentially means something significant just happened that the company needs to tell the public right away. GRAF Global Corp, the company we're looking at, is essentially a placeholder company, often called a SPAC, or a special purpose acquisition company. Its main job is to raise money by going public and then use that money to buy another actual operating business. Think of it as a shell company looking for a target. The big news here happened on the 26th of June 2026. This report tells us about a deal they made to keep their operational clock ticking. Now let's talk about what people own when they invest in GRAF. They have units which are like a bundled package. Each unit contains one Class A ordinary share, a very tiny piece of ownership, and half of a redeemable warrant. Warrants are like options, giving you the right to buy more shares later at a set price. So you can buy GRAF-U units, which trade on the NYSE American. Then there are the Class A ordinary shares themselves, trading under the ticker GRAF, also on the NYSE American. And finally, the warrants GRAF-WS, which also trade on the NYSE American. GRAF Global Corp is calling itself an emerging growth company. This means it gets to follow some slightly easier rules for reporting and compliance. This section gets to the heart of the matter. GRAF and its sponsor, which is like the main investor group behind the SPAC, made agreements with some of their existing shareholders. These are called non-redemption agreements. Here is the core of the deal. Certain shareholders promised not to ask for their money back, or they agreed to take back any requests they'd already made to get their money back. This is crucial because SPACs have a deadline to complete a business combination. If too many shareholders redeem their shares, meaning they take their invested money out, the SPAC might not have enough money left to buy another company, and it could be forced to shut down. So what do these shareholders get in return for not cashing out? The sponsor group is giving them some of their own shares called founder shares. These are shares that were initially given to the sponsors. This is a way to incentivize these shareholders to stick around and support the deal. It is essentially a sweetener to ensure there are enough funds to move forward. This is the ultimate goal. By getting these shareholders to agree not to redeem, GRAF expects to have more money left in their trust account. Why does this matter? Having more cash in the trust account makes them a more attractive partner for a target company and increases the chances of closing a deal. This section is about formal changes to the company's foundational documents. So on that same day, the 26th of June 2026, the company held a special meeting for its shareholders. The main purpose was to vote on changing the company's articles of association. What did they change? They extended the deadline for GRAF to find and merge with another company. This is a critical move to give them more time. This section details what happened at that shareholder meeting. At this meeting, shareholders voted on two main things. First, they approved extending the deadline to find a business partner from the 27th of June 2026 to the 27th of September 2026. And in a bit of a safety net, if they sign a deal by that September date but don't close it, the board can push the deadline even further, up to 3 more months, to the 27th of December 2026. Second, they approved adjourning the meeting if needed, which basically means they could postpone the vote or gather more proxy votes if there weren't enough people voting the right way. Let's look at the voting results for this important extension proposal. A significant number of shares, over 21 million, voted in favor of extending the deadline. This shows strong support from many shareholders to give GRAF more time. However, about 1.6 million shares voted against it. This indicates some shareholders are not happy with the delay or perhaps have lost confidence. Notably, there were no abstentions and no broker non-votes, meaning most shareholders who could vote did vote. And for the proposal to adjourn the meeting if necessary, the votes were very similar. Over 21 million votes in favor of adjournment and just over 1.6 million votes against. This is a crucial piece of financial information. In connection with this meeting, a substantial number of shareholders, over 14.5 million shares, decided to redeem their shares. They got back about $10.86 per S-share from the money held in trust. After they cashed out, there was about $91.3 million left in the trust account. This is the money that GRAF has available to potentially acquire another company. After all these redemptions, the company now has about 14.1 million shares outstanding. Most of these are Class A shares. This section just lists the documents attached to this report. It is mostly technical filings. Here we see the actual documents filed. Exhibit 3.1 is the amendment to the company's Articles of Association, essentially the legal document that extends their deadline. Exhibit 10.1 is the form of the non-redemption agreement, the contract that ensures some shareholders won't redeem their shares. And finally, the signature block signed by James A. Graf, the Chief Executive Officer and Chief Financial Officer on the 26th of June 2026. So, what is the story here? GRAF Global Corp, like many SPACs, was facing a deadline to find a business to merge with. A lot of shareholders decided to cash out, which is a common trend for SPACs that struggle to find deals, or when the market for SPACs cools down. This filing shows a strategic move to keep the company alive. They got certain shareholders to agree not to redeem their shares, in exchange for giving those shareholders some of the sponsor's own shares. This action, combined with the shareholder vote to extend the deadline, gives GRAF Global Corp more time, specifically until the 27th of September 2026 and potentially even the 27th of December 2026 to execute a merger. The key takeaway is that this isn't necessarily a sign of a strong, booming company. Instead, it is a maneuver to avoid dissolution. The fact that over 14.5 million shares were redeemed means a large portion of investors wanted their money back, while the non-redemption agreements and the deadline extension by GRAF time. The success of this SPAC ultimately depends on finding a suitable acquisition target, with that remaining $91.3 million. If they can't find a good deal, this extension will just be delaying the inevitable. Historically, many SPACs that go through multiple deadline extensions and have high redemption rates struggle to find a successful merger, and many end up liquidating. The risk I am watching is whether GRAF can find a valuable business to acquire before its new extended deadline expires, especially with a significant portion of its initial capital already cashed out by shareholders. What I am actually looking for is news of a definitive merger agreement. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. We also have a Discord community linked in the description below.